Welcome, everybody. I'm Mark Peter Davis, managing partner of Interplay. I'm on a mission to help entrepreneurs advance society, and this podcast is definitively part of that effort. All right, today's a fun one. We are doing a recap of the 2024 predictions from the team over here, things people said a year ago. We're going to review those and lay out some 2025 predictions. I'm also going to start this off by giving you my thoughts on 25. Before I jump in, though, just note this will be the last podcast of the 2024 calendar year, and we will pick things up again in January 2025. All right. So I have some thoughts on what's going on. For those who have followed this for a bit, you probably know I sit somewhere between tech and geopolitics and history and the way I nerd out and what I'm interested in. So I wrote down some notes here on some thoughts that I want to share with you, but I've taken them from the perspective of the tech and venture landscape, and then they navigate systematically over to geopolitics. So I'm going to cover a bunch of stuff. I think 2025 is going to be the first major year of the AI application layer. Everything that's been going on in AI so far has more or less materially been infrastructure layer and starting to bleed into some B2B. I think we're going to start seeing new consumer and SMB-oriented technologies that are going to become more prevalent in more people's lives. I think this is, the party hasn't really started, it's about to. Also on the tech side, I think humanoid robots are going to be piloted in the workforce in 2025. So I think this will be the first year we're going to see them in the news, on the line, building cars, working in warehouses, and actually entering the workforce in a way that it's going to be small, probably not lead to a massive displacement, but it's going to start to raise eyebrows, and I think it's going to enter the national conversation. From the venture investing perspective, my gut is I think this is going to continue to be a good year for venture investing. Valuations in the early stage where we play have been down for the last couple of years post the last crazy boom cycle. And we think I'm optimistic that's going to be a very attractive period going into 25. There's not enough recycling going on from liquidations of companies back to the LPs, back into the VCs. And as a result, there's just fewer people writing checks and kind of driving up valuations. Now, of course, it's a tale of two cities because there's crazy valuations going on the AI side of the world. But I think the vast majority of the market, if you cut out kind of the top 5% of valuation range, looks pretty healthy. I am optimistic that the IPO market is going to start opening up. It's been a very, very painful dry spell on the IPO side. And I think that we may not get into fifth gear, but I think we're going to end up in second or third gear through 24. There's a lot of incentives around that. I think market optics around the new administration and government is going to be positive for that. And you put all those pieces together, I think there'll be some momentum that will play well for business psychology, which will translate to IPOs. And the same on the side for M&A. I think there's a major impact of the new administration will be to unlock a lot of purchasing power from big corporates. A lot of big corporates have been dialed back on acquisitions during this last cycle to avoid government litigation. And my expectation is that's going to largely come off the table. We've been in a period of deglobalization. A lot of people don't know this, but the world was fully globalized before World War I. We were trading very, very heavily like we have been over the last period. World War I hits and that goes off a cliff. And, America is basically building its own supply chains. And all of that holds until after World War II, when the U.S. agreed basically to police the seas and make the entire globe safe to trade again. We're entering in this new phase where we are deglobalizing. There's a good book on this if you want to read up, far smarter than I could articulate. It's got a scary title, though. The End of the World is Just the Beginning. It's a wonderful book, but it makes the case that the world is going to deglobalize, and it's going to be pretty bad for almost every region except for North America. But North America, and by virtue of luck and geography, more than politics and brilliance. So just a little bit of luck here, but I think it's going to have a significant outcome if that book is right. But we're going to see Canada and Mexico being further integrated with the U.S., Canada replacing kind of the operational supply chain that we're seeing out of Southeast Asia right now. And what I think this is going to end up doing is shifting American policy to really look at the health and safety of our neighbors. And my suspicion is, as this continues, the U.S. is going to become very aggressive and active in trying to police the cartels and shore up the governance in the Mexican regime. So I think that could be a really interesting and complex part of this next chapter. I heard a recent idea from someone smart that I'm sure they got from somewhere else, that the administration, given the relationship with Elon, is going to make a Kennedy-like declaration of a mission to Mars. I certainly would be excited about that. So what I can tell you for sure is 25 is going to be extremely interesting. There's a lot in play. I'm watching a lot of these pieces personally and trying to draw threads from historical context. And I'm sure most of this is wrong, but it's going to be a fascinating period to be alive for. All right, and with that, we're going to jump in and let the other partners kind of chime in on what they predicted for 24 and what they think for 25. All right, let's do a recap. We had you on last year. You did your predictions for what would happen in 2024.
How'd it do?
Mid. And we'll run through those, kind of do a little recap, and then hear what you think is going to happen in 25.
Okay, let's do it.
And I'm excited because I'm hoping, in these conversations, you're going to pique my interest too.
Remind me my mistakes.
Okay, well, I'll let you kind of square yourself here.
Yeah.
So first off, you commented on valuation trends. You thought Series A average valuations would be higher in 24 than 23.
Okay.
I think bingo, right?
Yeah, I'd say
not a lot.
Not a lot. And the data just came out from Carta. It's pretty flat on the general. The exception is going to be some of the hypey AI deals.
Yeah.
So I think the sort of where I was right was we have a new secular trend in venture. Everyone knows about it. It's called AI. And there are a lot of companies in that space raising at Series A's at stupid high valuations again. We're back in it. Welcome back.
It's the pre-bubble. It's like the subsector bubble, which eventually might spread to the whole industry and become a bubble again.
Totally could. Probably will.
It will.
Whether it's 3 years or 10 years, who knows?
Just not. I think it's not 26.
But generally across the market, it looks like Series A valuations were flattish to slightly up year over year. So yeah, I think we got that one.
All right. Next topic, you threw out that growth capital was going to become more abundant and available, and we were coming off a pretty tough 2023 on the growth capital side.
Yeah. I think on this one, I was probably wrong. If I really am I'm objective about it. Growth capital became more abundant for the very small subsector of foundational AI and some hypey AI companies, OpenAI, Anthropic, Claude, etc., Soros. But it didn't return to the general venture market in the way that I was hopeful that it would. And I think that's a function of the fact that interest rates did not decline the way that people thought they would. And the market didn't clear up with IPOs, which I think we'll touch on a little bit as well. So that market is still stuck, I'd say. And if I'm going to be honest, I don't think there's like a very clear path right now to unsticking it.
Well, I think that creates an opportunity, which in theory, supply demand should fill it. On the IPO market you just hit, you thought the IPO market would reopen and become attractive again.
Yeah. Super wrong on that
Super wrong.
Yeah, I think kind of like...
Why didn't it open in 23?
I think it's a combination of interest rates, sort of general inflation fears, and these companies and founders still not really willing to be more open about fair and transparent pricing.
I think there's also some perception with in the LP community that GPs are not moving the companies to an IPO from the board, that there is some misaligned incentives happening.
I think that's fair, but the likely misaligned incentives are that the late stage GPs are still underwater in these companies or not making money. And they're like, something looked good for us if we IPO this business here, flat it down from the last round.
Right. They got to officially take that mark.
You got to take the mark.
It's going to show their returns not as strong.
Yeah.
And then they got to try to raise money against a worse track record.
Totally. And I think the only glimmer of hope there is Service Titan just put their S1 out. They're going to go public shortly. It looks like it's going to trade now above the expected range. So they've moved the price range up. It's going to trade. It looks like something around 10 times revenue. It's not a profitable business, which is nice to see because I think it gives a little bit of light to other non-profitable late stage software companies that they could perhaps go public to, even though they're not profitable yet. So I think that's the glimmer of hope right now that, okay, I'll say that my prediction this year is that the IPO market will be better than last year. But that's not saying much because I don't think it could possibly be worse.
Right.
So
fair.
Anything greater than 0 is good here. So that's my prediction. And I think you could see a nice slide of companies behind it.
You also threw out that you thought the LP capital flow into the venture capital business would pick up.
Mm-hmm.
And that's a tale of two cities right now. That story has two sides to it.
Yep.
It certainly has picked up. And I think the denominator effect went away as the public markets popped and people were no longer overweight of venture, but they weren't getting distributions.
Yep.
So a lot of LPs still sitting on the sideline waiting for payouts.
Yeah, you're nailing it, and you hear this more than I do as being kind of the front seat on Interplay's capital raise. But we hear this all the time. To reiterate it, LPs are excited to deploy capital into venture again. I think is the psyche.
They're frustrated,
but they're frustrated because they haven't seen the capital come back, and they have existing managers re-upping, and they have commitments to those funds, and they have outstanding capital commitments, and that's a very real thing. And I think we are acutely aware and understanding of that position, but are excited to see capital start to return to LPs so that the money can flow through the market.
All right. You said for the New York VC landscape, while we're on VC, despite some firm closures, the number of VC firms in New York will continue to grow.
Yeah, I don't have the data on that offhand. I haven't seen any year-end data on that. I do think that the market in New York is still thriving. I think it has consolidated power to bigger firms, which is the trend that we saw in San Francisco and will likely sort of reemerge in New York. And the other trend you're seeing in New York is, look around. We're in Soho here. 5 or 6 large San Francisco firms have opened offices within 3 blocks of here. So
right.
I think the San Francisco firms are becoming bicoastal now as they see that the New York ecosystem
it's real.
Yeah. I think the data I saw from Carta, though, was I think San Francisco was $7 billion of startup funding and New York was something like 3.
Yeah, it's a 3 to 1 is kind of the pattern I've been seeing.
Yeah, it's still significantly
Which, by the way, when I
there.
started in this business, that's a totally different orbit than we were
Right,
in.
it was 1,000 to 1.
Yeah, it was 50 to 1, actually. Something like that. It was crazy.
So, I don't think the game here, just for general sentiment, is I don't think the game is like we have to catch them.
No, of course not.
Yeah, the rising tide will sort of lift all boats.
Yeah, and what's interesting is I think the bias towards more capital intensive companies out there. I think there's kind of a different capital need. They're doing bigger J curves out there than we're doing out here.
Totally,
and so they should have bigger capital pools. And I like it when there's well-funded, well-oiled startup ecosystems everywhere. I think that's good for the economy.
Right. And to your point, OpenAI raising a $6 billion round, that skews the data.
Sure. And also the other thing on this one is, seeing firms close, that doesn't happen quickly. There's a lot of walking dead in venture.
Yep.
They've got 5 more years of fees and, they're holding out hope that they're going to be able to raise more capital, but...
A lot of that. And you can tell, though, by just general activity, who's still writing checks, who's in the market, who's not. And it's become less competitive.
All right. Last one, which kind of out of your wheelhouse. Those are all venture related. You thought there was going to be a Democratic win on the presidency.
Yeah. Crazy what a year can happen in a year.
I think Biden was still running when you threw that out.
Had he even announced yet?
Yeah, I don't know. We all presumed, I think.
That's a good question. When did he announce his presidency? Well, we were obviously wrong on that.
Yeah.
I think at a high level, though, you have to sort of re-question what blue and red means in this country, right? If you take a step back now and think about what the value set is of each party, it's changed. Yeah. It doesn't look like what it looked like, even 4 years ago, but certainly not 8 or 12 years ago or sort of decade ago.
And this has happened throughout history. I don't know if everyone knows, but even during Abraham Lincoln's time, the Republicans were the more northern, what we would call Democrats now. It was completely the opposite. So he was a Republican nominee, Lincoln, but they stood for what you would espouse as like kind of the Northeastern.
Right, the Democratic value system,
At the time.
That we had known for the last 30 years or longer. But was wrong there. Without commenting too much on it, it does seem like the markets have reacted well to the transition. And I think there's a lot of optimism around sort of the Doge, Elon, Vivek team.
Yeah.
I think as capitalists, we should all be excited about the prospect that our government could theoretically balance or pass a real budget. I think those are important things for business growth, for startup growth. And I think deregulation would be huge. I mean, anyone who's ever run a business or tried to start a business has run into regulation head walls where you just shake your head and say, why does this exist?
Right.
And I'm sure they were all well-intentioned, but as anyone can point out, after a couple hundred years of a country's existence, you sort of have to look around and say, all right, well, maybe some of these things don't need to exist anymore. So I think there's general excitement in the venture startup ecosystem, and clearly outside of it as well, about a new administration and sort of a fresh look on the government. Now it's December of 2024 right now. Right. So we've got a long way to go until there's actually even a transition in the team. But if I'm making a prediction for the year, I think it'll be quite good for business.
Yeah. Let's talk about 25.
Yeah.
What do you see coming?
What is he coming? Do you want to narrow that down a little bit?
Give me a VC market prediction.
VC market
going to
prediction.
Change in 25?
Yeah, I think 25 is going to be the year of agentic AI. You're hearing this term a lot. I'll throw it out there.
I want you to define it for folks.
Yeah, I don't know if you can fully define it, but I can give my best crack at it. I think AI, as we know it today, has been like quite responsive. It's sort of like a text box prompt, and it can answer questions and do fun things and write memos and read PDFs for you. The hope is that we can flip that so that the AIs sort of act on your behalf, whether that's as simple as booking a flight for you. I hate that example because it's not hard to do right now, but it's kind of like the easy one to think about.
Yep.
To whatever that means they could do for you in a new environment. And I say that very open-ended because I think the V1 versions of that are all going to be things like booking a flight where you're like, oh, wouldn't it be nice if someone just do this for me? But like the real version of that is going to be the things that we can't think of right now. For example, like the Uber example is a good one. It's like you didn't know that you could call out a car from your phone until the Uber team created the app and GPS came to phones, et cetera. So I'm excited and optimistic to see what entrepreneurs can build this year in the agentic space where I'm like, oh, yes, that's what we need.
Right. When I hear agentic, what I'm thinking, an interesting social implication is it's essentially, there'll be new use cases for sure, jobs that maybe don't exist today.
Yep.
But it also does mean a lot of white collar jobs are going to move to tech. And there's a disruptive nature of the agentic concept. It's this great cryptic language for delivering that message.
Yeah.
But whether it's different types of professional services, from a travel agent and beyond, more and more white collar behaviors will be done by AI is kind of the subtext of it.
Yeah, I actually think, and as we're in the prediction land, it's fun to do that. I think it will be supplemented by AI. I think a lot of people go to this mentality of like, it's going to take our jobs. I am full stop in the camp that that's not the case. I think that it will be supplementing, improving, and increasing human productivity. And yes, you might not need 7 travel agents anymore. You might need 4 to do the job. But I don't think it's a situation where there's going to be mass layoffs behind it. I think you just won't hire that next employee. Maybe you can do it with the AI, or you do hire the next employee, and instead of growing 30% this year, you grow 50%.
Well, before electricity, they used to have people walk up and down the streets of Manhattan every night, lighting candles and lamps. They stopped hiring those too. Now, it doesn't mean we tallied those up into the unemployment number.
Yeah.
But, that you're replacing jobs. It doesn't mean the workforce becomes unemployed. They might for other roles might open up. But it's certainly going to create a substitute product for human labor.
Yeah. Although I agree with you. Although I do wonder, I don't know if the light equation is perfect in all situations. I think that makes sense for a subset of jobs for sure. There's another subset of jobs where it's like, okay, the guy still has to do the lights, but now he can do a whole block at the same time.
Mm-hmm.
Right?
Okay. All right.
And now they can do the whole city in an hour instead of doing the whole city in 3 hours.
Right.
Right. So I think my gut is that it's probably somewhere more in that middle ground than it is a black and white replacement of labor. I'm 100% aligned. There will be lots of jobs that are replaced by it.
Yeah.
But I think many more jobs will just be improved by it.
Okay. Valuation trends.
Yeah.
What's going to happen at Series A, our favorite?
I think there's still a tale of 2 worlds for another year. World one is this hypey AI, deep investment, deep misunderstanding, or maybe that's not the right word, lack of knowing how big the TAM is. And because of that, a forced overinvestment in AI, which is rational. And we've talked a little about this. And
if you have a mega fund, you need to do that sometimes just to make the math work at the fund level.
100%. And also, I think new waves in technology, people will always overinvest in it. Like you wouldn't look back at 2001 and say, oh, we shouldn't have put all that money in the dot-com era because it got lost. Like, no, like you're up 1,000x on the dot-com era.
Yeah.
Now, if you were in diapers.com, you got hosed. But if you were in Amazon, you're a trillionaire.
Right.
So I think it will look a lot like that this time too. Whereas like if you're in the modern Amazon, you'll be a trillionaire. And if you're in the modern diapers.com, you'll lose your money. But the long-term view will be this sector will be worth a lot more than what goes in now. But you will have lots of winners and losers.
Yeah. And the macro story, it's always in these innovation cycles. Someone smart wrote about this, that you need this over investment period to kind of lay the foundation. The key though, as an LP or a GP, is to make sure you're on the right side of these trades in these moments where, people are basically donating their capital to future progress.
Yeah.
And God bless them. But I want to make sure we're making money in the process.
Yeah. Aligned.
Okay. IPO market. What's going to happen? 25.
It can't go down.
Can't go down. It's going to pick up.
It has to pick up.
Okay. If we're at on a 1 to 10, where give me a benchmark for.
We're at a 0 now.
Okay. 0. So what on a 1 to 10, what's 25?
You know the data on 24. The data on 20, we had less IPOs in 2024 than we did in 2009. So the year,
and it was largest, like the prior 3 years too.
The largest banks in the world were collapsing. The financial market there was a question mark of whether it would continue to exist. We had more IPOs.
That's crazy.
That year than we did last year.
Right. So
does
that mean it's just pent up demand for 25? It's going to pop?
The US equity market was up almost 30% last year.
Yeah.
So you have this incredible bull market with no IPOs. Think about that.
Yeah.
I think one, it's regulation. It's too expensive and too hard to go public. Right. So if you're and there's too much private capital available at the growth stage for any smart founder to say, like, why would I build public right now when I can get money private? Why go subject myself to quarterly financials and quarterly calls and analysts not understanding your business and not letting you invest in long-term growth when you think you can still compound at 3x year over year? So, and there's a private market to supplement it now. So if you're in the founder's seat, I don't blame them. I do think for shareholders, for investors, for employees, for capital markets, for growth, they'll be better off if they went public. But from a purely selfish point of view, as a CEO of a growth stage company.
Okay, so 24 was a 0 out of 10.
I think we get to like a 4.
4. So the engines are going to be churning.
Yeah.
We're going to be in second gear maybe.
Yeah, there's an outside chance though. I want to just caveat this for next year that it's a 10.
Okay, you think there's a scenario where it gets hypey and goes crazy?
Yes.
Everyone who's been waiting sees that there's no more, you can IPO and have good outcomes, and then they all rush.
There's a window and there's demand in the markets, which I think there is pent up demand. I don't know how much, but there is. And I think there's an opportunity where people could do it.
Going to be an interesting year to be a hedge fund buyer.
Hedge fund buyer, wealth management firm, any large asset pool that's looking to do sort of syndication.
All right. Well, we'll check back in and see how off you are next year, bro.
I'm nervous.
Thanks for doing this.
Thanks, Mark.
All right, Chris, you ready for this?
Yep. Always ready. Born ready.
Whoa. That's intense. Okay. We're going to reflect back on 2024 predictions.
Okay.
So you made these a year ago.
Mm-hmm.
First thing you said was 24 would be a volatile year across asset classes.
Yep.
A lot of uncertainty in geopolitical elections and otherwise.
Yep.
How'd you do on that one?
Pretty good across the board, except for maybe US equity. I would say that if you look at commodity markets, they've had the most volatile year in recent decades. If you look at interest rate market, same thing. Pretty massive reversal middle of the year because of Fed expectations. US equity has outperformed so much this year versus the rest of the world, which means the volatility on that has actually dropped. Obviously, there's a bunch of volatility around the election, but outside of that, it's been a pretty stable, just trending up type of year. So not accurate with regards to US equity, very accurate everywhere else.
Okay, I'll give you 50-50 on that one.
Sure. Why not?
Credit crunch.
Yeah.
One of your, we talked about this a lot.
Yeah.
Coming into 24 about, commercial real estate bottoming out, regional banks getting hosed in that process.
Yep.
What happened there?
Credit is the strongest performing asset this year. The credit spreads have tightened massively. So if you take my word from end of last year's at face value, I was dead wrong. This is like, it couldn't be more wrong. It's the complete 180. But I'm going to hold that prediction. Let me extend that by one more year.
Same concept holds. This is a looming time bomb still. Just the wick was longer than we thought.
Yes. And we were in a way worse position this year at this point in time versus last year at the same time. So
it's still the theme of commercial real estate.
It's not just that anymore. There are multiple other ways of looking at this, which we'll touch on, I think, in a bit when you ask me about 25. But let's wait for a bit.
Okay. Yeah. So far, credit crunch didn't happen, but that very unfortunate party might be coming still. Okay. Yep. You had dollar weakening.
Mm-hmm. I would say 50-50 on that because it was weakening very much the first half of the year, only to take a pretty drastic turn. So dollar end of the year, slightly weaker, but generally flat. Mostly because of, again, sort of inflation sort of staying relatively sticky. The Fed is not cutting as much as the market anticipated. So it's a relative game. So due to interest rate parity. And so if you compare rates in the US versus rates throughout the rest of the world, US is not as what's considered dovish, so as aggressive in cutting rates as some of the other countries. And that led to sort of strengthening of the dollar in the second half of the year. I honestly, going forward, I don't see the weakening trend as much anymore. So if I have to make the same prediction, I'll take the opposite side of the positions. That I think dollar will likely stay pretty strong and stable going into 25. So I'll give myself a 50-50 on that.
All right. So far you're like half right on every topic, which I think is like means you're wrong on all of them.
Vol was I called it right. Anyways, yes, you're right.
Okay, regional diversification. This was a big theme that came up. You thought there was going to be a lot of capital and investment flowing into Latin America and Africa.
Yep.
And on top of that, you noted that you thought Argentina would not be dollarized by the end of this year. I
said that?
Yeah.
Are you sure? Okay. Anyways,
well, that's at least what the notes say. I can blame the translator.
Completely wrong there. I think, yes, there's definitely more capital flow into those regions. No question. That's been a trend continuing trend for the past couple of decades. So that's easy prediction to make. But Argentina actually outperformed pretty much everybody's expectation this year.
Yeah.
Currency is stable, inflation's tamed, and overall doing strong. One of the highlights of, in fact, South America. So I'd say
the world.
Yeah,
it's got to be.
They're a good example of what needs to be done in a very difficult environment when inflation is running wild. So I'd say they're good. Yeah, they're good in a good spot. That they're not going to be de-dollarized anytime soon.
The one on here that you got dead on the nail, you got right, is you said the Middle East conflict would expand throughout the year, and that couldn't be more true. But you and I think, frankly, everyone else who threw out predictions last year got the presidential election wrong.
Mm-hmm.
Everyone threw out it was going to be a blue outcome.
Yep.
And it's red.
Yep.
I wonder to what extent that's a byproduct of living in the bubble of the Northeast. We're in a blue bubble, and the kind of information flow and the groupthink, or just how much change throughout the course of 24.
Objectively, I really do think things change so much. No one could call the whole Biden situation, Kamala being stopped in. But at the time when I made the prediction, if you looked at the time, the prediction markets, which happened to be so accurate this time around, given the volume that was involved in those trades and transactions, every prediction market was saying that, Democrats are going to win. So polls, that was a little too early for polls at the time when we did this, but at least prediction markets, I was in line with the more probable outcome. But things have changed 180 for sure during the year, and no one saw that coming. But here we are.
Yeah, a lot of people got that wrong. There were some pollsters or some people who had called the election
Yep.
Accurately for 25, 30 years straight, who got this one wrong.
Yep.
Kind of a wild moment.
All the historical anchors around these prediction results, like for instance, dollar raised, right, for campaigns, and just this time is unprecedented. Like Trump campaign had 1/8, 1/7 of the money that Harris did, and somehow they still won, and that's never happened before in the history of U.S. elections. And going back to the same time last year, I will make the same call. There's no chance I would have called this or anyone else.
Yeah, Kia. There's just no way to know. All right, flipping over to the future. Well, we got a little bit of a political thread here. Trump's been announcing a lot of his cabinet picks. People haven't been confirmed.
Yeah.
If the majority of these kind of flow through and do get confirmed, which is expected, what does that mean for the markets?
Yeah, the picks so far have been, I would say, very market friendly, not just for equities, but also for cryptocurrencies. Interest rates yet to be seen, but also likely to be, the Fed is likely to stay accommodative, no matter, who, or not just the Fed, but the Treasury. So to providing liquidity in the economy and making sure it's stable. So generally speaking, across the board, it's been very market friendly, and that explains the rally you've seen before the election and after the election especially, and which will likely continue into next year.
All right, and the world's U.S. seems to be responding very favorably to the election economically. The markets are way up.
Yep,
seems like the narrative is clear for 24. We're going to land with the U.S. outperforming most of the world. Mm-hmm. How does that, in the financial market side, how does that play out in 25?
Yeah, just to throw some stats, I was looking at it this morning. S&P year to date is up 28% as of this chat, and NASDAQ is up 35%. Russell, which is small cap, is up 18%. Okay, and so if you look at that in context of past 75 years, where it's a really good year, not the best, but we're sort of in the 70 percentile or so in terms of performance versus U.S. itself. However, where things takes a very dramatic turn is when you look at U.S. versus the rest of the world. So if you look at the ex-U.S. index, global equity, the rest of the world is only up 8% this year. And that includes emerging markets, frontier markets, where, again, using a little technical language, where there's higher beta. So there's, if it's a good year, they're supposed to move a lot more than a stable market like the U.S. So if you really look at U.S. versus the rest of the developed world, where, let's say, the market volatility and is similar, the U.S. effectively outperformed the rest of the market by almost 30%. 30% in 1 year. That's dramatic, no matter how you slice and dice. So the bigger question, like you said, is like, okay, will this dominance and continue into 25? From my perspective, looking at signals across the board, the answer looks like a yes right now, and that's not just going to be in U.S. equity market. It will be probably in other asset classes as well that with strong ties with the U.S. Why? Because one, if you look at tail risks that the U.S. faces last year this time versus now, the U.S. actually, I would argue that tail risks have subsided. Geopolitics, election, all these things, uncertainties in the market. You're not really looking at a lot of that in 2025. And two, in terms of fundamentals, all the S&P companies, all the mega cap, big cap companies are still doing really strong. Everybody's earnings at historical highs. Of course, in conjunction with that, the multiples are also at highs for some of the sectors of S&P, not all, specifically like tech and consumer discretionary. But there are pockets where valuations are still very, very, very reasonable. So all that is to say that there's still likely room to run, even on a fundamental and valuation basis, supported by a very accommodative Fed. And by the way, interest rate curve now, if for those of you invested in interest rate markets, we're finally not in an inverted world. So interest rates curve are also normalizing, which means it's really good for sectors like financials and banks and brokerage firms. And people expect IPOs and M&A to come back too next year, right? So all of these things are positive signals, and where the transaction will happen, most likely U.S. companies. So all these things are saying that 2025 will likely be a good year. Will it be 28% up? less likely because of where valuation stands today, but will it be a low teen, high single digit, normal year, stable, not a lot of vol? Personally, I think so. So I do believe, to summarize, I do believe that U.S. dominance and outperformance versus the rest of the world will likely continue, especially versus the strongest competitors like China and Europe. And it's difficult to see that U.S. loses out on that race.
How about asset classes? Are there particular
Yep.
categories that you think are going to outperform or underperform in 25?
Yeah, let me lead with my strongest conviction here, just by looking at data. I'm truly a little worried about the credit market as we stand here. Why? Because since basically second quarter this year, all credit products have been just on a tear. Like we are at historical tights in credit spreads, both in high investment grade and high yield products and loans. We're talking about tights that was last reached in 2007 before the financial crisis. And yet at the same time, if you look at the fundamentals measured by default rates and recovery rates, they're trending in the exact opposite direction. So default rates have picked up. There's a report by Moody's, I think, that was released to the public in end of November, that in their research, they're basically saying they expect default rates to continue to pick up, especially in the first half of 2025, and recovery rates to drop. So fundamentals are deteriorating, and yet on a valuation basis, we're at the absolute highest that we've seen. There's not a lot of room to move higher.
Right.
And on top of that, we talked about real estate, which has been the can seem to be kicked down the road at this point, because it seems like a lot of the transactions and funds and firms were able to refinance because there's so much liquidity in the market. But that doesn't solve the issue, which is the debt keeps, a leverage in the system keeps growing higher. Productivity is not rising as fast as people predicted. So there's no solving ourselves out of it using productivity and tech yet. And national debt is still there. So we expect, of course, the government to be more efficient next year. Hopefully, the exact impact is unknown. But all of that is saying like this snowball keeps growing, and we're at a point where it seems like it might break as soon as next year. So I'm fairly bearish on credit products next year. There might be a small credit crisis. There could be plenty of triggers that led to it. So I do expect credit to likely underperform next year.
And it's just a bad, potentially a bad asset class to be buying into, or do you think there's broader ripple effects of this?
Oh yeah, definitely. Credit is at the anchor of basically all the products is leverage, and every equity is inherently subordinated to credit, and therefore it's inherently levered. So I think there will be repercussions to basically all asset classes, but I don't expect this credit crisis to be big because the fact that the government and the Fed and the Treasury is so accommodative, and they will do everything in their power to make sure there's enough liquidity in the market. So it's not going to be a 2008, very, very, very unlikely. But could credit spreads all of a sudden widen a 200 basis point from here, in a matter of 3 weeks? Absolutely. And that could trigger a lot of sort of balance sheet imbalance, asset liability mismatch, which then requires additional liquidity to be pumped into the system for a company to be more levered up. Absolutely. So will that impact equity? For sure, temporarily, but probably not enough to say we're going to have a down year because of that. So I do expect equity to be okay despite the risk in credit. And I definitely expect commodities to do pretty okay, continuing its really strong trend this year. Gold, silver, rare earth metals, grain, coffee, cocoa, all these things are supply chain disruption is still there. Geopolitics is still there. So I think there's a lot of tailwinds for these commodity to rally. Same thing goes for cryptocurrency. So I think next year will be a generally positive year, just with the question mark around credit, and I'm a little worried about that.
How do you protect your portfolio against that?
Well, you have to be, first of all, a lot of us are, depending on how you're using your portfolio, if you're cash managing, then there's not a ton you can do. Yeah, you simply try to not be sensitive too much to interest rates, not be too sensitive to credit. So there are ways you can use to hedge. If you're institutional portfolio, you can use products like CDS to hedge out your risk in credit. But honestly, the best way is just to make sure to stress test your portfolio with different sets of correlations and expected returns next year that are probably more negative than what the market expects, and just to make sure you don't get yourself overexposed and in let's say vanilla bonds and especially corporate bonds that have potential to widen out a couple hundred basis points at a time. But loans are okay still. Floating rate products probably okay. Especially if you're buying more securitized products, it's likely okay, because as long as you're not in the equity tranche, if you're in the higher tier tranches, overall risk is still contained. So there are still pockets in credit that are worth doing. Not saying that you just stay with a small asset class, but just stay away from maybe the most vanilla products that are just has a ton of credit risk and interest rate risk. Yeah.
Super, super helpful. Thank you for doing this. And a quick reminder to everyone listening, Chris is an SEC registered RAA, and nothing he has said here should be misconstrued as investment advice.
Thank you, Mark.
All right, Fong.
Hey, Mark.
Okay, so this is a fun one. We're going to go back through your 2024 predictions.
Yeah.
And see how right-ish they are, and then hit 25 ideas. Yeah.
Yeah, that sounds good. This kind of feels like
forecast.
I'm being graded on a test.
Yeah. Should we keep score?
Yeah, and how much I like
Mike
grades.
got like a 65%.
Oh yeah, I'm basically right around there.
You think so?
Which is technically enough.
Right. Yeah. Technically enough. Is this the first F
But I
you've
think
gotten
I
in your
can make
life?
a case for D+. So
Okay.
once I start talking, you'll figure it out.
Okay. So first one was generative AI adoption. Companies are going to figure out how to leverage generative AI, and it's going to change marketing, customer service, and industry-specific co-pilots will pop up everywhere. How'd you do on that one?
Yeah, I think I was kind of right on that, but I was mostly wrong. I mean, I think all of those things.
So F, got it.
Yeah, all of those things did, develop as options. But I think the ability of a lot of companies to implement them into their work streams and really get a lot of value out of them, a little mixed, right? So I think there's been a small number of companies that have figured it out. There was a BCG study that was done of 1,000 business leaders. Only 4% really acknowledge the fact that they've been able to implement it and get consistent, sustainable gains. Another 20%, admitted to kind of getting some gains, but 3/4 of them really said that they hadn't really gotten any substantial gains from it. It's still early days.
Yeah.
But
I think the story here is the early adopters. So some subset of the more agile, early stage businesses are leveraging this stuff.
Yep.
But it's not fully penetrated the market at all.
Yeah, I don't think
It's
so.
going
And
to be,
according to
just
this
not.
study, it hasn't been. And I think what was surprising to me was the fact that the challenges on implementing it wasn't really about tech. I mean, it was to some degree, like there was poor data quality and some of the algorithms weren't great, but that was just a small fraction of it. The biggest challenge to implementing are people and process related issues.
Right. I think there's a story here. If there's an AI technology that comes out that streamlines your job to the point where maybe you don't need the person sitting next to you, a lot of these organizations don't fire. What they do is they just don't replace the person if they leave, or if they need to grow, they don't hire as much. So they look to integrate productivity by preventing future hiring. And that's feels humane. There's a lot of probably reasons that happens, but it does imply a slower adoption cycle.
Right. It doesn't happen within a year. So I could be right, but I may not be right for another 5 years.
There you go. Okay. All right. Your next shot on goal here, you had customer acquisition costs rising. You thought there was going to be a lot more ad spend. And there was going to be an emphasis away from the traditional acquisition channels.
Yeah. So I was right on this one. I think that across both B2B and B2C sectors, we saw an increase in CAC, in some industries more than others. And that is driven by the fact that, digital platforms have gotten more competitive. So Google Ads, Meta, there have been increases in costs there, but then their user base has basically stayed the same. So now you're paying more for the same number of people. So that's been really tough. I think that for the industries that rely more on organic channels or relationship building, like real estate, brick and mortar retail, they haven't seen as much of an increase in CAC. But in e-commerce, fintech, healthcare tech, they've all seen kind of a relatively. It hasn't been huge. I think lower single digits, but still an increase in CAC.
Yeah, until there's new channels, this kind of feels like a forever trend.
Yeah.
Right. Like acceptance rates at top universities will continue forever to go down because there's a larger population applying for the same number of seats.
Yeah, unless there's some other, AI driven, marketing tools really help efficiency where customers or where companies are doing better at targeting, doing better with their content delivery, then I think we're going to see that.
All right. So 50-50 so far. You're batting 5.
Yeah.
That's pretty good. Talent attraction and retention challenges. You thought it was going to be a harder job market for the employers.
I think
24.
Yeah, I think that I was pretty right on this one. I think there's some metrics that show that it's become harder for companies. I think there's been increased competition for skilled labor, specifically in tech and in healthcare, those sectors. I think employers are struggling to differentiate themselves from other employers and really be able to give a value prop to candidates that are meaningful. And you can see that through metrics like, increased time to hire, increased cost to hire, and, decreases in employee engagement as well as job acceptances. So, I think that's something that, as we're figuring out how people are going to work in the long term, we'll keep seeing.
Great hit rate. 2 out of 3. All right. What do you got for 25?
Not bad. All right. Predictions for 2025. Some of these may feel a little obvious or that we've talked about, on a higher level, but I want to kind of talk about how it's going to influence specific companies and sectors. So the first one is consumer companies, which are, that's my background, really close to my heart. I think consumer companies are going to have a roller coaster year. Like I don't know if it's going to, pan out that they'll take a hit to their sales or performance, but they're going to have to navigate a lot of challenges this year. And mostly, and what I'm talking about specifically, it's from the tariffs that the Trump administration are proposing. So that's specifically, they're proposing a 10 to 20% tariff on imported goods, specifically 25% on goods from China. Mm-hmm. So if you're a consumer company that does a lot of manufacturing abroad, that's going to have huge impacts on you, right? I think overall it's going to cause prices to rise on top of the overall inflationary environment that we're in.
Yep.
So prices to rise in, consumer categories like electronics, vehicles, textiles, agricultural goods. I think that's going to lead to decrease in demand in some sectors more than others, right? I think for discretionary items, it's going to have more of an impact. So agricultural goods, maybe not as much. So I think the impacts on the companies will be obviously squeeze margins, right? They're having decreased demands, but increased costs. I think it'll have a big impact on supply chain, right? I think with increasing prices, you're going to see companies having to reconfigure their supply chains to optimize their pricing. That takes time. That takes money. There may even be retaliatory tariffs from other countries that will further disrupt the supply chain. So that's not great. And then lastly, I think the impact around inventory management, which for consumer companies has always been really important, but now they're going to have to really focus on that because the last thing you want to do is holding on to high priced goods that you can't sell because demand's gone down.
Yeah, no, I think the overarching trends there are dead on. And there's a great book, if people haven't read it, by Peter Zahan, maybe mispronouncing his name, called The End of the World is Just the Beginning. And it's a bit of a shock title by design, but he really talks about how the world is slated to go through a period of deglobalization. and our supply chain in the US is going to be really increasingly connected to Mexico. And so if you look at everything that was being built in China and now Vietnam, increasingly the incentives are just going to be to move it to North America.
Yeah.
And that transition is going to be fairly brutal. I think the takeaway for the average consumer is buy everything you want now. Prices are going to go up. There's going to be shortages if this keeps going. There's a lot of inflationary dynamics in a lot of the policies from the people coming in.
You're actually just put our whole audience on panic mode.
Just buy
There's going to
everything.
be run on Amazon orders.
Yeah, by the way, I have an affiliate link. No, I'm just kidding. All right, number 2, what do you got?
Wait, sorry. One last thing on that is that I do think there might be some positives coming out of this.
Oh, I think there's pros and cons for sure in this change. It's just clear we're already in this transition, as far as I can tell, to a North America-based supply chain. This isn't even related to particular politicians. Or even parties. This is a decade-long trend.
Yeah.
And it's already happening. I think it's going to be accelerated. And I think overall, it's actually good for security.
Yeah, and also for sustainability and kind of,
long-term, it's probably really good.
Yeah.
But, change is hard.
Yeah. And in the short term, I think, having a more competitive environment will lead to more innovation.
Mm-hmm.
Companies are going to have to, in the competitive environment, really work on their value propositions, make their products better, make their brand experience better and the customer experience better. So, it might be better in some ways for the customer overall, short term.
And it's creating some interesting business opportunities if you're paying attention to any of those change dynamics, because you can see what to sell and what to buy pretty quickly. Okay. Very cool. What do you got next?
Okay. So prediction number 2, I think we're going to see big leaps in the customer experience based on AI and predictive analytics. So I think companies are increasingly using real-time customer data from diverse sources that really allow them to see what customers are doing, where they are, how they're feeling. And I think what's going to result from that is that we're going to see hyper-personalized changes in the customer journey across the entirety of that journey. So, and specifically, some areas that I could see impacted is on marketing. I think you're going to be seeing more relevant targeted ads, messaged in a way that's really relevant to how you're doing and what you're looking for. I think that transactions will be faster, will be more, convenient, easier with tools such as voice activated shopping, automated payments and checkout. I think that's just going to make it kind of something you don't even think about. Pricing, I think, could be better, is going to be optimized with dynamic pricing models. That's going to allow companies to maintain their margins, but offer competitive pricing to their customers. Customer support, I think, will be more proactive. I think with predictive tools, companies are going to be able to anticipate issues with products and services before the customer even experiences it and be able to offer solutions. And I think the omni-channel experience is going to be even more seamless. That's something that, companies have been working on for forever. But websites, your experience across their website, apps, and social media is going to be completely seamless.
This is something that creeps people out, but I get excited about it.
Yeah.
People don't like that someone else knows who they are and can target to them. But as a techie customer, I love it because I want the tailored experience. That's how I view it. And I don't care what they know about me. What I care about is I'm getting the exact right product in the exact right way at the exact right time.
Totally.
Some of my favorite content on a lot of the social sites is actually the ads because they are well targeted. So it's, I think there'll be obviously some backlash as we get further down this rabbit hole, but everyone ends up liking it. And their behavior shows they like it because they click on stuff.
Oh yeah, people love getting targeted ads on Instagram.
They just don't think they do.
Yeah.
Right. All right. What's your third?
Okay, so third one, speaking of creepy, is I think that, AI adoption in people's personal lives is going to accelerate. And so that's going to narrow the gap between how you use AI at home and how you use AI at work. So I think the workplace has been a lot quicker in adopting AI technologies in task automation and even decision making. And in people's personal lives, it's been less. It has been less of a quick adoption. It's kind of in the earliest stages. I think it's going to accelerate over the next year and beyond. Specific categories that I think that people are going to adopt more at home. Smart homes, I think, are going to become smarter.
They're going to actually be smart.
Yeah, smarter than
rather
you,
than
maybe.
Just smart home
Yes.
right now means electric with a timer.
Right, exactly.
Right.
I think that with the predictive analytics, it's going to be able to help you with lighting and temperature control, grocery shopping, meal planning. So I think that's gonna we'll see a big jump in that. I think health and wellness will be another category. I think the technology there is going to help people with not only tracking their health, but also have better health outcomes.
Mm.
And then lastly, AI personal assistants.
Mm.
This has kind of been around for a little bit with Siri and Alexa, but I think that the technology is going to get so good that it's going to seamlessly, become a part of your life where it's like almost like a concierge.
Do you talk? I had dinner with someone the other night who lovingly called me a boomer because I use AI when I need information, like I would query a search,
Mm-hmm.
and I go and I get an answer, and this fella uses AI constantly as a conversational point. He talks to it the way you and I might talk to a human.
Yeah.
And in the process of doing that, he's educating and training the AI up on him. Do you talk to your AI as a friend?
I've been starting to more and more, but I'm not at that level yet. I had a friend the other day who used AI like he was in a personal disagreement, like a family matter with his brother, and asked AI to interpret a really passive aggressive text that he got from his brother.
Right. Like, am I the bad guy here?
Yes,
right.
exactly. It's
right.
like I haven't.
It's
gotten
your
to that
outside
level.
advisor. I don't use it for that.
I haven't either. But
I'm on market
feel
research and where to buy things. And
but I think maybe it won't happen within our age range.
yeah.
But I think younger generations.
Well, even if we're not
potentially.
first to adopt, you and I will figure it out. And our friends will be like, I don't get it.
Hopefully.
Yeah. Very cool. All right. Thank you for doing this.
Thank you.
All right, everybody. Thanks for listening to our predictions episode. Hopefully it was entertaining. It turns out predicting the future is damn near impossible. We're going to sign out for the holidays, but we'll catch you back in January 2025.